So really good nugget here is that if you buy something which is really good, it doesn't quite matter what you pay for it because it will grow.
Secondary over a long, well, let's just say it like this, the multiple to a point, whether you...
I think one of the reasons you want to avoid something like technical analysis is people like this won't take you seriously. They won't even talk to you for 30 seconds.
Buy it at... If it's growing, it's all maths. Yep, you've got to look at the growth rate, the terminal multiple, all the multiple. You will and if you're willing to hold it for a long...
I heard you say that there are more good companies in the public market than in the private market.
That are the ones that aren't as good. People...
So even if you don't prove yourself to be the best trader in the world, at least you can get a job.
You sure? I mean, what do you base? What do you?
I'd say a couple of things. Let's dig into it. I know it upsets people who are private equity. I happen to think that large companies, they have more money to compete.
Yeah.
And and switching costs. We think it's a small company that invents something new. We talked about Zoom. It can be crushed by a large company reasonably easily. They can copy. And large companies are usually...
Yeah, no, that's right, Mag. But I'm just talking about all of Wall Street, not just working for Chris Hone, which is not easy.
Too big for private equity. Private equity is too big for them. Yeah. And if a public company is selling, and I'd say is prone to where they are incentivized to gather markets, I believe are better than the top 100 companies.
Seller company.
When it's a view of interest, and including there are two components to it, if you like: intrinsic value. Yep. So the price still has to be at or below intrinsic value. But there's a second point, which it isn't...
You lose faith in
times, yeah? Mm. And what does that mean? You could call it confidence. What does that word mean? Because
I think you de-wave the whole space.
And you can be wrong, okay? And so...
I think if, let's say you have some percentage of your portfolio you want to allocate to shorting quantum, I'd say I'd be... Whatever that maximum amount is, I'd be sort of 75 to 90% of that maximum. You got to leave still a little bit more room, but this should be pretty close to the last gasp. We'll see. Again, you got to be prepared for anything in the stock market.
One of my first investments when I worked in New York, Bain Capital bought Control, €1 billion valuation, and then went to zero. It was a Yellow Pages company. When I first invested, the internet didn't exist. And so your risk of being wrong are higher. Mm. Technology is one of those areas.
Absolutely.
But if I own an airport, that is, or a toll road, let's take that we own, I'm less likely to be wrong than if I own a retailer. Yeah, my chances of being wrong are less because I have physical asset backing, substitution risk. So the thesis is much more obvious. Yeah, because
I mean, I'm sorry to interrupt. Trying to find this for ASW, but ASW, the problem with technical analysis is that people think there's no a priori reason to believe that it has any movement in markets. So I'll give you an example. I'm going to list 10 or 20 stocks here. Okay, I can actually pick here's 10 random numbers. And I can basically say, well, Amazon is my long because, this told me that Amazon's my long. And the problem is that, no, I don't think it's disrespectful, Greek name, Bayesian, Bukatak, or whatever. I think that it's a common misconception. Part of this channel is to help people avoid pitfalls. Um, Amazon is my number one stock because of my algorithm, let's say. Well, the problem is if you put this algorithm, which is just a random number algorithm, which TA is basically as well. Well, there's 10 stocks here. And 10 people employing this algorithm, someone's going to be right. And someone's going to say, well, my algorithm's working. Yours isn't. You're losing money. But of course, nobody has a perfect algorithm or heuristics or anything. So if you say, well, I'm up, etc. Well, there's monkey throwing darts, astrology, rolling dice. I mean, you could use the name of the company as a seed to try to divine the future. It's people have tried everything, but you have to do p-value, statistics, etc., before you can determine whether or not there is a causality and repeatability. So think what quants do is very different. So quants are not using technical analysis. I'll give you a few examples. So one of the major quant strategies, and again, statistical significance is really important. He has only a cat to ask. What are you talking about? Do you want to hear what I have to say, or do I have to stop and address every single person? Bless you. So anyway, getting back to the point. So here's a quant strategy, market making. No, I'm asking you what you meant when you said he has only a cat to ask. I really wanted to know what that meant. Ah, okay. Got it. All right. So market making is a mean reversion strategy. It's a short-term strategy. It doesn't really work with technicals. It's an idea of a trade-off of liquidity versus price. The person pressing the market is trading off liquidity for price. You're trading off your liquidity for a better price. And that's why there's a systematic return to market making. Well, banks do market making with their so-called natural flow. So natural flow is customers. What's evolved in market making and why the quantitative market makers have taken a lot of market share, not all of it, but quite a lot of it, is such that they are doing market making without any natural flow. So when Point72 goes to Morgan Stanley and says, I want to buy 1 million shares of the stock, yes, Morgan Stanley is going to price them on market. But Jane Street's not doing any of that. They don't have any natural flow. They're just trading. So anyway, so this is a strategy that's not really technically based. It's kind of more arbitrary. So there, yeah, Milan, of course, any strategy that can show a p-value. So basically the point of any systematic strategy is a really simple point, which is prove it. Right? Codify it and prove it, which is what quants do all day, right? That is a basic 101. No, I follow because you're trying to be beta neutral. So if you can't prove it, whether it's back testing or forward testing, then, it's not worth anything. So when quants try to find a strategy, generally they're trying to see, number one, an empirical reason, number one, they're trying to find a logical reason why the algo should work. And this is an important idea because algorithms shouldn't work for no reason, right? If you just find an algorithm in the sea of data that works, it's probably something called a spurious correlation, or a back fit, or a curve fit, or something that's just not going to repeat itself. So there's a lot of, you could set any machine to do this, and it's not going to repeat itself. This is a very classic problem in backtesting. And there's a lot of reasons as to why, but they're basic reasons. So the logical reason, 400 samples over 3 years does not count. I would never use that one. Because you're talking, depending on your holding rate and stuff like that, you're talking about 400 samples chosen out of 100 million events. So that's just cherry picking. Anybody can find a signal like that. And if it's only for one specific stock, that doesn't make any sense either. Whatever would work for one stock should work for every other stock. So that's an example of kind of like a bad algorithm. If you have a system, it's not hard to reduce it to, that's just not enough sample. If you have a system, it's not hard to reduce it to words, right? Like you should be able to take your system and write down, what is it that I do? When I see this, I do that. When I do this, I do that. And you just write it down and turn it into code. If you've been successful so far, you can afford to do this, right? It's not hard to do. And then go see if your system actually would make money if you employed it across the whole stock market all the time. And you'll probably find out that it doesn't, and that it's something else that's making you money. It's maybe your judgment, could be something that you can't put a finger on. It's a talent, many times it's a talent. But it's likely not to be, this system you have. Just give me a moment. I gotta take care of a couple things here. Nothing's impossible in the market. So again, this goes back to like some of the cassava stuff we were talking about with multiple errors or multiple comparisons, corrections. You cannot take multiple cuts of a data set and assign a p-value after the fact, because otherwise we can move the goalposts that suit us, right? The goalpost that matters is the one that we set before we look at the data. AI does teach a lot of these concepts. Overfitting is the major sin in AI.